Well, good morning, everyone. Thanks for coming in. It's really nice to see everybody today. Today is our first virtual Power Breakfast. We host our Power Breakfast to educate and engage, but also to promote innovation and technology here in our business community. Obviously, during COVID-19, we know that it's very, very important for businesses to have as much relevant information as possible and to make sure they can make educated decisions. I think as business owners, we've seen the changes of the climate, as well as how our different governments are dealing with it, as well as our suppliers. It's been changing daily, and so I think it's important for us to get together and to do this. As you know, we typically have a very nice breakfast, so I hope all of you have made a nice breakfast at home before you logged on, and you can have that breakfast while we have this call. So I'm just going to run through a few slides. So our purpose, for those of you that don't know, is to help innovative startups shape the future. Oops. So today's Power Breakfast is about economic impacts and shifts from COVID-19. Just want to make sure that I point out, we have a lot of organizations that really support the innovation cluster. So this is our core funding partners. So Fleming College, Peterborough Utilities Group, Trent University, the Angel Network, Kawartha Lakes, City of Peterborough, FedDev, Ministry of Agriculture, Food and Rural Affairs, and then as well as lots and lots of zone partners and knowledge partners. And it's really this community ecosystem that helps us bring together all the knowledge and in some cases some money to make sure that we can run and support our programs. We've got 5 very dynamic individuals, or 4 plus me, that are on the call today. And so we have John Gillis, who's our president, Rose Terry is our marketing manager and an innovation specialist. We've got Rachel Stark, who's a communications coordinator, Elena Dahl, who's operation, events, and I think everything these days, definitely our Zoom champion, and myself as the CEO. We also have a great board of directors. These individuals are pillars in our community, both in the business community as well as academia, and they provide a lot of their valuable time. They are volunteer board members, and if it wasn't for them, we'd have a very hard time both on governance as well as really understanding and keeping our pulse on what's happening in our community. So for those of you who are new to the innovation cluster ecosystem, I'm going to go through just a couple slides on how we impact Peterborough and the Kawarthas. So our first mandate is very simple. It's strengthening innovation and entrepreneurial capacity. And as you can imagine, in this time and the crisis that we're having today, a lot of innovation comes out of crises. So we're working with both our existing clients to understand how to pivot, maybe how to make sure that they can help out our communities. But also we've got a lot of new entrepreneurs that are coming in and want to know that some ideas they may have, maybe because of reduction in labor force where they work, they now have some free time, and they've probably gone from spending the first week watching Netflix to now coming up with some great ideas. And so they're constantly working with us and calling us, and we really kind of work with them to understand, is this a viable business today? Is this just going to be relevant maybe during the crisis we're in, or is this something that you can really build into a long-term business? So we do a lot of that. We assist those organizations on that new company formation. So if they are good business ideas, and if we work through all the different pieces that you need to understand when you're starting a business, we'll help them go through the processes of starting that business. And we also grow our knowledge-based economy. And so we're constantly working with events like this. We typically have two lunch sessions that we're doing now that per week, which basically brings in different speakers. Obviously, our topics have a COVID flair to them, but in many cases, we're also going back to a bit of business as usual. Like I said, we've got lots of clients that we're currently supporting that are still building their businesses in this time of crisis, and so we're making sure that they still have the same programming that we had before. Those of you who are thinking about being a client, it's very, very easy to become a client. Basically, go to www.innovationcluster.ca and please register there, and definitely we'll reach out. And last but not least, we have Rhonda Keenan from Peterborough and Kawartha's Economic Development. They're one of our key strategic partners, and Rhonda's going to say a few words about her organization. But if it wasn't for PKID, they fund our breakfast today, and they make these possible. So I'm going to turn things over to Rhonda and just unmute her mic. Oh.
All right, good morning, and thanks, Mike, and good morning to everybody. I'm sorry that the breakfast that you normally receive under the Power Breakfast is make your own, so I apologize for that, and hopefully we'll get back to a better gathering in the future sometime soon. I am with Peterborough and the Kawarthas Economic Development, and we are the regional economic development agency for the city of Peterborough and the county of Peterborough. And what that does is we really are here about business support overall and how we are growing our local economy. Earlier this year, we launched a strategic plan called Future Ready. I think now that was pre-COVID, and now we are now in the process of developing an economic development plan to get us through to post-COVID and into full recovery. So having these events like the Power Breakfast, where we're able to understand what's coming at the business community so they can respond most appropriately, is something that we are happy to be a partner with the Innovation Cluster, sponsor this breakfast. And with that, I know we're going to be resilient and we are going to get through this. And I look forward to the innovation and the new companies that are developed out of these really difficult times. So with that, I will send it back to Mike. Thank you.
Thank you, Rhonda. And once again, thank you for your organization supporting this. I think it's, like I said, it's very, very important. And I know we typically have 3 calls a week as we've been going through this crisis. And Rhonda's been doing a great job of leading both, how to deal with the current situation, but also really working with a number of groups to put together a recovery plan. We understand that as we come out of this, it's going to be very important for our community to have a good recovery plan. And, Rhonda's definitely been doing that. So thank you, Rhonda. So next, I'm going to introduce Andrew Pyle. So this session is going to be facilitated by Andrew Pyle of the Pyle Group and Scotia Wealth Management. He's going to provide you with information on the economic impact of COVID-19, projections for the future, and the anticipated economic shifts. This session today will hopefully help attendees gain an insight into COVID-19 and how it's having a growing impact on the global economy and what that means. A little background on Andrew. For the last 25 years, he's held several senior market analyst positions in Canada's financial industry, advising individual clients, businesses, charity organizations on financial issues. Prior to joining ScotiaMcLeod, he was the vice president and head of capital market research for Scotia Economics. He was the Chief Canadian Strategist for the Dutch bank ABN AMRO. So during his career, he's provided economic and investment advice to corporations, central banks, and some of the largest investment funds in the world. He's widely quoted in the media, appearing regularly on radio and television, and is often asked to speak to industry groups and community associations. Andrew also works with clients across Canada. He lives here in Peterborough, which is very exciting for us. He's an active contributor to the community. So now I'm going to turn things over to Andrew. And just before I do that, there is a chat window that will appear at the end of Andrew's presentation. If you want to put any questions in there, you can put those questions in. And then what I'll do is read those questions back to Andrew and let him answer them from there. So now I'm just going to turn things over to Andrew. Wherever Andrew is on my screen here somewhere. There he is. Okay, Andrew, you're live.
Thank you, Mike. Thank you so much. And thank you to the cluster for inviting me this morning to be a part of the Power Breakfast and try to shed some insights as to where we think we are and where we might be going with respect to the pandemic and obviously the economy and markets. It's interesting that if we just went back to February and just think about what life was like or how we felt about things with respect to the economy or the markets. Believe it or not, we were actually engaging in discussions about how things were looking better from 2019. There were concerns back in 2019 that perhaps the North American economy may be entering into a recession. There were some reasons for that. We were dealing with a US-China trade war that was having a devastating impact on manufacturing in the States and elsewhere. We were talking about the possibility that an inverted yield curve in the United States could be a precursor to an economic recession. But January, February, the mood changed and we were becoming quite optimistic. Markets, if you remember back to February, I know it's not that long ago, markets actually hit record highs in North America. We saw economic indicators beginning to turn north again. There was even hopes that Europe was going to look better. So we're kind of basking in this light of things were going to be so much better in 2020 versus 2019. And it wasn't that we weren't aware of the coronavirus. I mean, we've known about this going back to the beginning of the year. We'd heard about it. I think the market collectively decided that it was not going to be an issue. And, you know, to put it in perspective, during the month of February, we saw additional information every day with respect to how this virus was spreading and how it would potentially spread, and yet we continue to see the financial markets continue to move higher, at least until the third week of February. And then pretty much everything changed. Markets became a lot more concerned about what was happening with respect to the virus. And then, of course, we entered March, and then we started to lock down the global economy, or very large parts of it. And I think this is what makes it very difficult, because we've dealt with recessions before. Globally, we've dealt with depressions before. We have never, ever orchestrated an economic shutdown before. And at the end of the day, that's really what makes the analysis of what is happening currently, and more so what is the projection of economic recovery looking like, it makes it that much more difficult to deal with. So I thought before we get into just where we are right now, we take a little step back and maybe take a look at history, because at the end of the day, we look to history for guidance. As an economist, as a financial analyst, I am always looking back through time, looking for patterns, looking for situations that may be similar to what we're dealing with now, trying to take those patterns and extrapolate perhaps in formulating models as to what might happen going forward. So if we think about when was the last time we've actually had a recession, or a global recession, that was really back in 2008, 2009. That was the financial crisis. That episode for us, for most of the world, was basically a 4-quarter recession. In Canada, we fared a little bit better than the United States. We suffered through 3 quarters of contraction in an output of our economic, or of our economy. Other parts of the world did a little bit better. If we think about where we are today, people are now talking about a global contraction in 2020 of anywhere from 3 to 4%. Now, again, to put that in perspective, if we went back to 2008 and 2009 and looked at what happened to the world economy overall, we saw a very, very fractional decline in the economy for 2020. So what we're talking about in 2020 is going to be a lot worse than what we saw in 2008, 2009. 2008, 2009 was actually less of a recession, even though technically it was a recession, but it was not the recession that we typically think of. It was more of a balance sheet experience, or what I call a balance sheet implosion, propagated by a massive decline in the US housing market, which permeated through to the financial system. We saw banking failures. If you think about where we are today in 2020, the banking sector overall is on much more solid ground, especially in Canada, but also in the States. We are actually looking to banks today to play an active role in relieving the economic stress that we're dealing with in the wake of the pandemic, versus 2008, 2009, when we were basically bailing out banks, not in Canada, but definitely in the States. You'll hear a lot of people talking about, worst contraction since the Great Depression of the 1930s. But again, if you go back in time and look at that period, it wasn't like it is today. The depth of the contraction, if you go back to the 30s, is kind of similar to what we're going to go through this time around, whether we're talking about the economy or if we're talking about employment. But again, it was still more of a traditional contraction. What I mean by that is, if you trace the elements of what happened in the Great Depression, it basically started off with a stock market that was much more overvalued, or very overvalued, relative to the underpinnings of the economy. The stock markets began to slip, then we crashed. That crash in the stock market created a wave of pessimism through consumers and businesses. We saw businesses beginning to drop spending or contain their spending. Investment spending fell. We saw layoffs. Basically, this led to what we now know was a 10-year recession or a 10-year depression. The difference between then and now is that back then we didn't have a lot of things at our disposal that we have now. There was no real Federal Reserve in the United States, no coordinated central banking across countries. There was no such thing as a Federal Deposit Insurance Corporation. That's a very important takeaway, because back then a lot of individuals feared that their banks were going to collapse and that their deposits would be wiped out, and they literally went to the banks, took out all the money, and we had a run on the banks in the States. That's not happening today. It's not happening in Canada, and one of the reasons is because we have supports like the FDIC. There was no Securities Exchange Commission. There was no policing really of the stock market. There was no coordination between countries in terms of how do we control for massive spikes in volatility. And we didn't really have a government experience in how do we deal with an economic calamity of the sort that we were looking at in the 1930s. And if you go back in time, it wasn't really until we had FDR come to power in 1933 that we started to see real constructive government measures being taken to address what was going on in the economy. So on that note, I just want to take a look at some of the things that we're looking at currently to give us some insight as to what type of recession are we dealing with, what are we likely to see. I've had discussions with clients and investors over the last number of weeks, and one of the key themes that I come back to is it's almost like a counseling at the end of the day. The numbers that you see on TV, the numbers that you're hearing on the radio, that you're hearing people like me talk about every day, sound extremely ominous. A lot of Canadians I know are at home, obviously worried about their jobs, worrying about their life savings. And we'll hear things like, the worst economic contraction since the 1930s, or, record high unemployment rates. And I know a lot of people are concerned, and I've really gone out of my way to try to explain to people that this is a different experience. You cannot orchestrate a shutdown of an entire economy and not get the types of numbers that we're getting right now. And I think that's an important takeaway. And I think for a lot of people, they get that. People like yourselves who are in business understand that this is different, but a lot of Canadians probably don't. The first chart on the screen, I'm just going to pick off a few indicators just to give you some color. This is a U.S. leading indicator. It's looked at by a lot of economists for a guide as to what possibly could happen in the coming months or coming years. As you can tell, if you go right to the end of the chart there, back in 2019, we did start to see the leading indicator flatten out. And this gets back to my earlier comments about concerns with respect to US-China, with respect to the yield curve. Had we raised interest rates perhaps too much in 2018? These factors really influence what this leading indicator was doing in 2019. And this is why a lot of economists last year were starting to talk a little bit more bearishly about the outlook. I've been talking a long time about, we will probably encounter economic headwinds within a 1 to 3 year period. A lot of people have said, well, we haven't seen it yet. Economists are famous for forecasting, 13 of the last 3 recessions, but the leading indicator definitely last year was starting to point to something that was not going to be as robust. That changed as we came into this year. We saw the leading indicator starting to pop up, but you can see what's happened in March. And again, keep in mind, a lot of the charts I'm going to show you today are ancient history. In normal times, we wouldn't call them that, but we call them that now because we're dealing with something that is so fluid that even when I talk about something that happened last month, we're not capturing all of the information that's impacting us today. If we had the April leading indicator in our hands today, it would be a lot worse than what you're seeing on this chart. So clearly we're now into a phase where we're going to see this indicator decline sharply in April, probably in May. The question for economists is, does this indicator point to the recessions that we've seen in the past? In other words, if you look back to 2008, 2009, a very, very sharp decline in the leading indicator. which was consistent with basically a one-year recession in the States. In terms of how businesses are feeling, we look at several indicators to get a gauge as to how American businesses are responding to things like the pandemic. What are their intentions going forward, but just basically what is the sentiment amongst CEOs in the States. The index that I've put on the screen in front of you today is what we call the Philly Fed Index. It's a Federal Reserve generated index of business sentiment. It's one of the most closely watched sentiment indicators that economists look at. And one of the reasons we do look at it, it captures information very, very quickly. As you can see, the last data point for the Philly Fed Index has taken us to levels that are actually below where we were in 2008, 2009. We're actually below levels that we saw in the early 1990s when we went through a similar economic episode. And as you can see on the chart, we're now back to levels that we haven't seen since 1980. And I'll come back to 1980 later in the presentation, but that's a very important takeaway. Economists now expect that this index will, in fact, probably hit record lows when we release the next round of statistics in the coming month. A lot of you have been listening to news about what is happening to layoffs. Canada has actually seen tremendous layoffs in the last several weeks. The United States, one of the indicators that we track weekly is what we call jobless claims. You'll hear, or you would have heard yesterday news that there was 4.4 million initial jobless claims in the States. That was actually a lower number than what we've seen in the last few weeks, where we've seen numbers north of 7 million per week. I thought more instructively would be to put a chart of what total claims are looking like right now in the States as of the last several weeks. And you can see right now that total US jobless claims are up to just over 16 million. We have roughly 26 to 30 million people now out of work and will be seeking unemployment insurance. This number dwarfs any peak that we've ever seen in the post-World War II major recessions. And again, going back to 2009, you can see that claims were just a little bit over 6 million in total. So we're now at levels that are 3 to 4 times. But again, coming back to my earlier point, there is no way on earth that we should expect anything different than what we're seeing. We've literally laid off forcibly 26 million people in the States, and we've laid off tons of people in Canada. So these types of statistics are understandable, but they are quite scary for people that don't follow them regularly. In terms of what this is going to do to unemployment, it's clear that we're going to see unemployment rates in both Canada and the States get back to levels that we've never seen in past recessions. It's a little bit harder for Canada. We haven't been tracking comprehensive economic or employment data in Ottawa since 1976 or prior to 1976. So when I say things like we're probably going to see record high unemployment rates, we're only going back to the 70s. But even for the States, most people now expect that we will see an unemployment rate probably around 15%, which again would be higher than any post-World War II economic calamity. Of course, if we're going to get lower unemployment, we're going to see consumers responding negatively. 3 things that really factor into how consumers feel about their situation and what could influence their spending, which is key for us when we look at Canada and the States, because in both countries, consumption represents the lion's share of economic output. We'll look at things like the indicator I've put on the screen right now. This is the Bloomberg Consumer Comfort Index. The reason we look at this is it's a weekly series. We can look at monthly data, but again, monthly data is going to be, in this context, at least ancient history. So we look at the weekly data because we can capture changes in consumer psyche a little bit more frequently. And as you can see on the chart, we've already started to see consumer psychology impaired by what we're going through. The 3 things that will influence this indicator at the end of the day: jobs is key. If people have a job, they tend to be a little bit more confident about their circumstances. The state of the stock market has a profound impact on consumer confidence, and the state of the housing sector. If the housing sector is strong, that will tend to give us a slightly better consumer confidence read. It's unclear how far consumer confidence declines here, and the reason I say that is because even though we're dealing with record high unemployment, We're also getting guidance behind those numbers, either from people like myself or government officials, that this should be a transient experience. In other words, the layoffs that we're seeing today will not be permanent in the context, or quasi-permanent like we've seen in past recessions. I think that's having a positive influence in terms of where consumer confidence is. From an equity market or stock market point of view, we've seen a partial recovery in equity markets around the world. That too is going to play a role in shaping consumer confidence as we go forward into the month of May. And for now, the housing sector, while we are seeing strains in terms of listings, we are seeing mild declines in house prices, nothing compared to what we saw in 2008, 2009. So that's the silver lining when we think about consumer confidence, and that is absolutely critical, because if there's going to be any pent-up demand coming out of this, we need the consumer confidence levels to actually support a level of spending that helps generate the recovery coming out. And just generally speaking, in terms of what we expect to see in terms of the economy, very messy chart. I'm sorry for that early morning, but what this chart's really showing us are the quarterly movements in both the Canadian and US economy going back to 1970. The reason I'm putting this up is because when you hear talk in the markets or talk in the press about recessions, how long is a recession going to be, we look at the quarterly movements in the economy. And so obviously any time that we're below the zero line, we're in technical contraction, 2 quarters or more, and we end up with an economic recession, or what we call a traditional economic recession. Data on GDP is going to be more lagged than anything else that you're seeing in the press today. So the last data point we had for both countries was back in Q4 of 2019. You'll notice that for Canada, we were actually trending down towards 0 in terms of GDP. So again, getting back to my earlier points last year, we had issues with respect to trade. Canada is a small open economy, more sensitive to global trade issues than the States. And so we were seeing a much greater impact on our economy than what we saw in the States. But again, these are ancient history numbers. We will not get first quarter numbers for Canada until we get to the end of the second quarter. All joking aside, economists again are famous for forecasting recessions that happened yesterday. But quite honestly, folks, by the time we see confirmed information on Canada that we've got a recession or we had a recession, we quite honestly could be out of the recession. So the GDP statistics are not going to be a useful guide for you as business owners in trying to guide where we're going through this. Just in terms of the markets, again, as I said before, early February up to the third week of February, markets were feeling quite good about things looking forward. We actually saw record highs for the stock markets going into the first 3 weeks of February. We started to see a little bit of panic emerge in the last week of February. In fact, as you can see on the chart, or on the slide, U.S. stocks or U.S. major indices dropped about 12% in that last week. We were down about 10% in the TSX. We saw the central bank of the United States come forward at the beginning of March with an emergency rate cut of 0.5%. That was our first indication that authorities were going to take this seriously. That actually helped give the markets a bit of a bounce going forward. Once we got through a few days in March, we saw markets collapse. And I would label what we saw in March as pure panic selling. People just pulled the exit lever. We saw institutional investors selling. We saw retail investors selling. We saw people that probably should never have been in the stock market selling. Long and short of it, we literally wiped another 30% of stock market value off the table in those last 3 weeks. On March 23rd, when markets had hit bottom, or hopefully what we think is bottom, this was actually one of the quickest bear markets in history. And if you go back to March 23rd, markets were down about 35–37%. And if we go back in time and look at past recessions, that magnitude of decline in the major indices was pretty much what is consistent with a traditional two-quarter recession. If we go back to that initial phase of selling in March, again, I label it panic selling. It was panic selling for a very good reason. And that is the market was staring down a black hole of the unknown. We had not dealt with a pandemic of this sort in modern history. But more importantly, we had never orchestrated an economic shutdown before. So business owners, consumers, individuals, government policymakers really had no clue what to expect the next day, let alone the next week, next month, or next quarter. The focus of the markets, quite honestly, shifted to help. Help being what can we expect to see governments and central banks do to help remedy the situation. Central banks had already initiated support in terms of rate cuts. We were hearing the announcement of programs from central banks to try to maintain the stability of financial markets. Government authorities, unfortunately, were late to the game, not just here at home, but everywhere around the world. I've opined on why we couldn't have had a more robust response quicker. I was talking to a client yesterday about what do we do in the financial sector in the wake of 9/11, the terrorist attacks. Every single 3 months we have to do continuing education on guarding against terrorist financing. We do it every quarter without fail. We haven't had a major terrorist attack, I don't know in how long, but we still do it. And we have fire drills for the same reason, yet I don't know why we couldn't have actually had a more robust stack of programs in our bailiwick ready to go when we hit this. But that's hindsight. Governments were late, but again, as I always say, better late than never. In terms of what has been done on the monetary front, again, this graph is just looking at the Federal Reserve key interest rate, the Fed funds rate. We are now back to the lows that we saw after 2008 to 2009. We're down to 0.25%, which is where we got to. And we got here in a much shorter period of time than what it took us back in 2008, 2009. Again, if we go back to that period, that was, even though it was more of a balance sheet episode, it was a traditional recession. It permeated through the economy. It's like, as I said, I think in the presentation yesterday, it's, you walk down the street one day, one of your neighbors has been laid off from a job. A few weeks later, you walk down the street and another neighbor kind of comes up to you and said, oh, I just got laid off from my company. Totally unrelated companies, but that's what a recession does. It trickles down. People lose jobs over a period of time. Here, we just sent everyone home. And here's your recession. So the response by authorities has been that much quicker. On top of the rate cuts by the Fed, we've seen billions and trillions of dollars put into the market to provide liquidity in the backstop. The Bank of Canada has done the same thing. So our Bank of Canada rate is again down to 0.25%, which is where we got to back in the last recession. We've done it in a very, very short period of time. And the Bank of Canada, I think, has done a very good job again in mimicking what the Fed has done in providing liquidity to keep the various markets alive, the bond market being notable. The bank is now backstopping provincial bonds, municipal bonds, corporate bonds to make sure those markets are functioning the way they should do. As I said, fiscal policy, better late than never. Right now in Canada, we've spent over $150 billion in federal aid or federal initiatives aimed at addressing the issues surrounding COVID-19. Provinces have added that much more to the pot. The US, if we factor in yesterday's unanimous approval of $484 billion in the secondary fiscal package, we're now probably talking at about $6.5 trillion in total fiscal aid in the States. That number will probably go up. And in Europe, we've seen fiscal stimulus that 3 years ago, 4 years ago, would never have been conceived of. Europe has been extremely lax in terms of getting fiscal support to the economy. The European Union has been criticized by countless economists in terms of not providing the necessary support. We're now starting to see that support in desperation, I would say. We probably will see other initiatives, as I've indicated on the slide. We're probably going to see infrastructure being the next key thing, and I would agree with that. I think in both Canada and the States right now, we should be addressing infrastructure. We're not just talking about buildings, bridges, and roads right now. I think given what we're dealing with now, what it has forced us to do, I think broadband is just good or as strong of an argument for infrastructure spending as putting a new highway and a new bridge. So I would expect these initiatives to be announced as we go forward. Coming back to the markets for a sec, this has been a very tumultuous period for investors, obviously. This could have been worse. A lot of people may roll their eyes and say, I don't know what's worse than this, Andrew. Markets don't know what's going on. They don't know which way we're heading. Economists can't figure out where the economy is going. Companies are not even providing guidance anymore as to what their earnings are going to be in the next 12 months. How can I navigate through this? But if we just take a step back and take a look at how the markets have dealt with this, this is the graph on the screen right now is the Dow Jones. And I apologize for putting the dice on there. I really don't use dice when I try to figure out where things are going. Darts are usually a lot better. But just to kind of give some perspective to what we've been through, March 23rd, when the markets hit their lows for the month, we were down 37%, massive decline. We basically wiped out a couple of years of growth in the Dow Jones index. That's not good news. But if we go back to the financial crisis of 2008 to 2009, when the market lost more than 50% of its value in the space of about a year to year and a half, we literally wiped out 11 years of growth in the valuation of the Dow Jones. So we've wiped out 2 years versus we wiped out 11 years. And I always bring this chart up when I talk to people because we have to put things in perspective. As bad as things look, this could have been a lot worse. I know a lot of you are going to be, a lot more focused on what's happening in the tech sector in both Canada and the States. Tech sector has done extremely well throughout all of this for one very good reason, because a lot of the companies that form the tech sector, when we think of it from a stock market point of view, are providing the necessary and essential services and equipment and activity that is keeping the economy alive to the extent it is. In fact, we're having a Zoom meeting today. Take a look at where Zoom stock is. Take a look at where Amazon stock is. I don't see any less parcels being delivered to my wife's door during this crisis than what normally happens. So, tech sector has done extremely well in this. The NASDAQ is down, believe it or not, single digits from the beginning of the year. And as I said yesterday, if I said that to anyone in March when we were going through this panic-induced selling episode, if I'd said to anyone, give it a few weeks, NASDAQ down single digits, no vaccine, no end in sight really for the pandemic, people would have laughed me out of the room. But that's where we are today. In terms of the bond market, I've been told or I've been asked over the last number of years, when do we come out of the bond market? The bond market rally is over. My parents were buying bonds in the early 1980s and getting 15 to 20%. We've had a rally for 30 years. It's got to be over right now. We're going to get to the bond market. Yields can only go up. I've heard that argument so many times, and yet yields just keep going down. Last summer, yields were around 1.5%. The chart that you're looking on the screen is the 10-year U.S. government bond yield. We were at 1.5% last August, September. Same arguments. Rates can only go up. And actually, I was starting to think at that point, we had stretched the rubber band a little bit too far. Rates probably would go up. Yields would probably go up. Yields now are below 1%. You give the U.S. government money for 10 years, they give you back less than 1%. Great deal. Go to Europe, give the German government money for 10 years, you pay them. So bond yields didn't go up. They've gone down, and we've stretched the rubber band even further. Bad news for savers, bad news for our senior clients who are looking for income to support their retirement lifestyles. GICs are no longer 4%, folks. Good news for borrowers, right? The silver lining for governments is that they can borrow money at ridiculous rates. And there are going to be investors that are going to give them money. I know a lot of you are probably scratching your head saying, I don't know why I would give the US government or the Canadian government, for that matter, money for 10 years and get less than 1%. But if you're an insurance company and you've got to match assets and liabilities, guess what? It's the only game in town. Just quickly in terms of oil, this has been a very interesting week for the oil market. I'd say it's been a very interesting year for the oil market. Just as a backdrop, if we went back to February again, we were already dealing with cracks in the oil market. There was no agreements by OPEC to rein in production when we were just kind of talking about it in a non-emergency sense. As I've said to everyone, this is more about geopolitics at the end of the day and less about oil. We have a situation where the US oil industry has blossomed in the last decade. The US now has become the largest producer of petroleum on the planet. We couldn't make that argument 10 years ago. Shale production has gone through the roof, and some countries in the world don't like that. And two of those countries would be Saudi Arabia and Russia. So what we had going into March, before we were even dealing with the pandemic, was basically a price war where both Russia and Saudi Arabia wanted to gain back market share from the US. We would do that by not following disciplined production cuts. That sent oil prices down from above $60 a barrel down to 40. Then we got the pandemic. Now we're evaluating a demand destruction for the use of oils. Just think about basic things like how many times are you guys driving your cars? What are we doing in terms of factories? Multiply that by factors, and you get a situation where oil drops down to $20. Where we are right now is in a very precarious state with respect to oil. On Monday this week, something happened that has never happened ever. And that is the price of oil went negative. And I know a lot of you have seen the media reports on this. It happened for one day. It was largely a technical issue in that what we're dealing with and what you're seeing on screen here is an oil futures contract. In this case, the first contract, which on Monday was the May contract, and Monday is the expiry of the May contract. And I don't want to get too technical with my conversation on this morning, but essentially, when you play the futures market, if you do not settle out or close out a futures contract by expiry, you own whatever that contract is. In the case of oil, you're going to take possession of oil. Problem is, we're producing so much oil and not using a lot of oil that we're running out of places to store oil. So, land storage is running short. We're now loading tankers with oil, and we're starting to run short of tankers. So people on Monday literally thought that they were going to take possession of oil, have nowhere to put it, so they dumped their contracts. And the dumping of contracts sent oil down to as low as minus $40 per barrel. So before everyone kind of ran out and said, I guess gasoline now is going to be minus 20 cents a liter at the pumps in Bridgenorth, and they're going to pay me now to fill up my car, not quite. The following day, oil prices went back to about $15 a barrel, $17 a barrel later. In other words, people feel that we will start to come out of this by the end of June. We will address the production overhang because we are going to have production cuts implemented by OPEC and other nations on May 1st. And we won't have to deal with this panic frenzy. But what happened Monday was also an ominous sign of what could happen. If we do not see favorable indicators going forward, if it looks like the global economy is going to be in a protracted recession, if global demand is going to be hit for several quarters and not just a couple, we could be right back to where we were on Monday in terms of the June contract. And if we run short on storage, that's what's going to happen. So Monday was a cautionary note. It was a technical note, yes, but I think it's a cautionary note going forward. So I'm asked a lot about how does the recovery look? When do we get out of this? And, you know, I would be lying to everyone this morning if I said I know exactly what's going to happen. If I ever say that, you can tune out. What I will say is that the evolution of the recovery outlook, and it is an evolution because this is a fluid environment. This isn't a traditional environment where we can plug variables into a model, spit out a 95% confidence of an outcome taking place in 3 months. We're not there. If we use the markets as a guide, markets at the end of the day are forward-looking. So typically the stock market's supposed to tell us what is likely to happen 6 months down the road. The markets right now are using a base case scenario whereby the global economy, or at least the North American economy, starts to get back on stream sometime in the summer. That process might start in May, might start early June. It doesn't mean we all go back to work in June. It just means we start to see people going back to work. We start to see businesses getting back online in the summer. And then that builds every single month all the way through the second half of 2020. It continues to build into 2021. And by then, we're starting to see growth numbers that are more traditional in the recovery, the early stages of an expansion. Stock markets have improved. Unemployment rates have gone down. That's what I would call the base case scenario today in the market. Depending on who you talk to in the market, you'll have people saying that this is going to happen really, really quick. There's somebody in Washington who tends to talk about this every single day. We're going to have the strongest economy ever. It's going to be the quickest rebound ever. It's going to be the best, of course, that we've ever seen. V-shaped recoveries are nice. We do get V-shaped recoveries. I would argue today V-shaped recovery is probably a naive forecast, only because we can't get people back to work as quick as we got them out of work. So that would be the definition of a V-shaped recovery. How do we get a V-shaped recovery? It's like having a dream, and in the dream, somebody says that they've actually created a vaccine for COVID-19. We have billions of vials ready to go. Everyone gets vaccinated tomorrow. We all go back to work. That's the V-shaped recovery, and that's why it stays in our dreams. It doesn't come back in reality. What we're more likely to see, I think, is more of a U-shaped recovery, where again, it's kind of like a trending evolution of people getting back to work. And that U-shaped recovery takes us into 2021. In both of those circumstances, we're talking about a recession that began basically in March, and it's done by the time we get to the end of the third quarter, right? Again, not talking about what the fourth quarter looks like, just that's what we get, 2-quarter recession, and that's what the market has baked in right now. To give you a little bit of historical context on the recessions that we've seen since the war, we've actually only had one 4-quarter recession in the United States, and that was 2008, 2009, believe it or not. That's the only 1-year recession that the States has actually gone through. We have been through 2 3-quarter, 1974, 75, and 1953, 1954. And since the Second World War, we have experienced 5 traditional minimalist 2-quarter recessions. 2 of those recessions, 2 of those 5, took place in what we now refer to as the double dip recession of the early 80s. And I said earlier in the presentation, I'd come back to that experience that we had. Double dip recessions are what we call W-shaped recoveries. This type of recovery is what I'm getting asked about more and more for a lot of reasons. A lot of people think a lot of the problems that we had last year coming into 2020 are going to resurface even if we get through the pandemic and cause the economy to fall back on its heels. Second, and I think more salient, is basically that we could see the virus resurface later this year to the extent that it actually caused economic activity to dip. I thought I'd kind of put a chart up just so you can see what we went through in the early 80s. And I'm not saying this is what I'm predicting is going to happen this time around, but it gives you a sense of how a double dip recession could emerge if these criteria fall into line by the end of the year. In other words, you get this sharp dip, which we saw back in 1980. We're going to see that in the second quarter numbers when we get them. I would suspect that we're going to see GDP contraction numbers north of 10% in the States. In other words, it will be worse than 1980. I don't think we're going to get a lift in growth in the fourth quarter like we saw back in 81, but they will be reasonable. I think it's not unreasonable to see economic growth of 4% in the States in the fourth quarter, or 5%. Same thing here for Canada. But then, as you saw in 1981-82, we get that backpedaling. And it's the relative magnitudes I want to draw your attention to this morning. It's how we have the big hit, recovery, and then we get another hit, but not as bad. And I think that's a very, very likely scenario, especially if we start thinking about that in terms of the virus. Because if the virus does come back at the end of the year, CDC is predicting it might be worse than this wave. I tend to think it probably won't, mainly because we've dealt with it. We kind of know how to deal with it again. I'm not saying we'll have a vaccine by the end of the year, but I think we'll have better testing capacity. I think more people will just simply be immune to it by the end of the year. So for a whole host of factors, I think the shock won't be as great, but we'll get a shock. The economy will probably backpedal and the markets will backpedal as well. Assuming we get through all this, by 2021, and we're looking back at this and saying, it was a terrible episode. The things that we did got us through this. It's now 2021, maybe 2022. The recessions are over, markets are up, people are back to work. We've got a vaccine, hopefully. What will be the things that we need to think about then? And I think these are very important for business owners in Canada beyond 2022. And that is, what are the longer term implications of what we've been through? We are seeing things in terms of government support and monetary support that we would never have conceived of. We saw things in 2008, 2009 that we thought we'd never see either. We didn't think we'd ever see a 0% interest rate. We never thought the US government run massive deficits to protect the economy, yet that's what we did. We've taken that and we've actually magnified it by several factors to deal with the pandemic today. At the same time, forget the governments for now. Let's just think about people and think about businesses. We know for a fact that businesses and consumers now are having to tap into their credit lines to make ends meet. People are using their Visa cards and MasterCards to buy groceries, not because it's convenient or they're earning points, it's because they have no income. Businesses are running out of credit facilities with the banks. Yes, we've got programs in place, but it's not enough to absorb this entire demand for credit that's taking place. Heard a story yesterday that Nordstrom, one of the big US retailers, literally has maybe just north of 30 days left of credit before they're going to shut the doors and declare bankruptcy. So these are real problems, and that additional debt that we're adding is going to continue as we go forward into 2022. People have asked me, all of the stimulus that we're doing, is it going to result in higher inflation down the road? Potentially. In terms of what to expect in terms of the numbers, the chart on the screen is the US federal government deficit. I use the word balance only because there was a period in the late 90s that we actually had a surplus, believe it or not, in the United States. Those days are long gone. We actually had surpluses in Canada, believe it or not. We haven't seen that for a while. Back in 2008, 2009, we had deficits of $1.4 trillion, unfathomable. We had deficits for more than $1 trillion for 4 entire years. And the smallest the deficit ever got to recently was just under 500 billion. The line at the far end is just my own estimate of where I think we're going to be in 2020. In other words, 4 trillion. It might be more than that. In terms of total debt, so if we want to think about government debt, individual debt, corporate debt, prior to the pandemic, the US was running close to a record high in terms of debt to GDP. In other words, roughly 250% of the size of the US economy is what constituted total debt in the States as of the fourth quarter of last year, before the shutdown. There's not any real reliable estimates as to where this number is going to go in 2020, but clearly this number is going to shoot up just as it shot up back in 2008, 2009. For 2 reasons. 1, debt is higher. 2, GDP is lower. So if I take the denominator down and I take the numerator higher, this ratio is going to balloon. That's fine for 2020. The concern amongst economists is going to be, where do we plateau out at? And do we actually see an improvement in this ratio going forward? There was really no improvement after the financial crisis. This is going to be a massive issue beyond 2022. Because as long as interest rates are low, we don't have to worry about debt. When interest rates start moving higher is when we'll have to consider what is going to happen to debt servicing for governments, debt servicing for corporations, debt servicing for individuals. Back to the question about inflation, because I know, again, a lot of people are going to ask me this. Inflation isn't going to go higher. Next 2 years, probably not. We've been living in a very strange world. We've lived in a global economy that has been deflationary for the past number of years. That's not going to change in the next 2 years. It's going to be more deflationary now. Take a look at the price of oil. Going forward, 5 years from now, 10 years from now, perhaps. But I've made this argument with a lot of people that when we start to see interest rates go up next, which could be 10 years from now, it's likely to be happening because of demographic forces. In other words, excess borrowing, not enough revenue going into the coffers from taxes, deficits going up, not because of pandemics, just because they're going up and they're structural. That will cause interest rates to go up, and it could go up without inflation going up. And in terms of interest rates, clearly central banks are not going to be in a rush to push interest rates up anytime soon. Took the Federal Reserve 7 years to get rates back or start to raise rates after 2009. If you look at where the Fed got to in terms of rate hikes before it started cutting again, we literally only got to half of where we were before 2008, 2009. If the same thing happens this time, we're talking about short-term interest rates staying low for longer and short rates not getting back to where we were even last summer. Again, from a business point of view, this might not be a bad thing at all, because if you need to finance business activity, you're talking about short-term interest rates staying lower for longer. It's longer term and long-term rates I'd be more concerned about. And finally, in terms of governments, as all of you are probably aware, government deficits can't stick around indefinitely. At the end of the day, like people, we have to balance the books. And if we can't balance the books through growing or having a viable economy, then typically we look at it from the other point of view and we say, well, we can cut, that's possible, or we're going to raise taxes. So I think for the next 1 to 2 years, governments are not going to be in a rush to raise taxes. Beyond 2021, 2022, I would not be surprised if governments, depending on the government, of course, does not start to look at measures where they can raise revenues through taxation increases. I mean, this is just a given. Anyone that thinks 5 to 10 years from now we're not going to see higher taxes in Canada and the States is really back in that same dream where we got the vaccine this morning. This is going to happen, and it's something that I think businesses need to prepare for. And again, just as I indicated, the demographic forces that have always been at play, the demographic wave that we were dealing with before the pandemic, we're going to be dealing with beyond the pandemic. The pandemic has done nothing to change the demographic realities of the world going out 10 to 20 years. The Chinese population will start to shrink. It didn't need a pandemic to shrink. It's going to start doing that. Germany's population will shrink. Japan's will shrink. So we're going to be dealing with this irrespective of the pandemic. My concern is we're going to be dealing with these demographic issues now with a weakened fiscal state and perhaps a weakened economic state. So on that very cheery note, I'm going to pass it back to Mike and open it up for questions.
Excellent, Andrew. Well, thank you very much. So you'll see your chat should be open now for everybody. And I'm going to read off a few questions. So the very first question is, Andrew, what's your advice to older retired folks who've seen significant losses to their portfolio and who are drawing money out of investment to live in those older years?
That's a good question, Mike. I think for older individuals, prior to, I'm going to go back a little bit, prior to 2000, we never really thought, or retiring individuals never really thought we'd ever see a situation where a financial market, equity market could drop by half. Yet we experienced that between 2000 and 2002, and we experienced again in 2008, 2009, and March just passed, we were down 35%. So I think people in retirement right now have every right to be worried about what is going to happen to their finances and how they're going to support their retirement lifestyle. Unfortunately, because we've been living in an aggressively low interest rate environment for the last number of years, a lot of seniors, a lot of retired people have been forced to venture out the curve, put in more riskier assets into the portfolio than they normally would or probably normally should. And they did that in an effort to try to get a yield that would support their lifestyle. And yet now we've had this other shockwave go through the market where they've lost money. I think the advice I would give to those in retirement is, again, one, don't stretch in search of yield. And this is going to be hard medicine for people. I have this conversation with a lot of people when we do financial planning, and you do a plan for someone and it doesn't work. What they'd like to do in their retirement years, they're not going to do based on the assumptions we plug in. They have three choices. They can work longer if they're still working, or I guess if they're retired, they could go back to work. They can trim back their lifestyle aspirations. They're going to spend less, in other words. Or they can take more risk in the market to try to make more money. And we always say, don't go to option C. So I think for those people in that camp right now, it's two options on the table. Unfortunately, some people probably are going to have to find employment to supplement their income, or they're going to have to rationalize and look at a retirement lifestyle that perhaps is not going to be as robust as what they had thought about 5 years ago, or even in February of this year. So this is going to be a very difficult period, and it's going to be compounded by the fact that interest rates again are going to stay low. So a lot of people are going to be panicked now. They're not going to go back to the equity market. They're going to want to buy GICs. They're not going to make a lot of yield. Inflation could go back up to 2 or 3%. So this is going to be very challenging. My heart goes out to a lot of the people who are in that camp, because this is going to be a very difficult environment to navigate.
That's great, Andrew. Next question from Matthew Savino, one of our knowledge partners, and it's two questions together. So first one is, how soon do you expect them to raise the capital gains inclusion rate to 75%? And the second question is, how much has the TSX fallen pre-crisis, and has index funds and ETFs generally fallen in the same way?
Yeah, so on the first question, it kind of refers back to what we were talking about earlier in terms of when do we see the inevitable? And the inevitable is going to be some form of tax adjustment to address deficits now that are so far above the glide path that we had envisioned, that it's not going to be the economy alone that's going to get us back, right? So I think anyone that thinks that the economy is going to skate deficits back to zero, I think is dreaming. The other thing to keep in mind before I kind of get to the answer is the U.S. has just been through an 11-year economic expansion, longest in economic history. I think there's going to be some people out there that think we can do it again. I would be surprised if we're able to repeat that when we come out of this pandemic. And irrespective of the shape of the recovery, even if we had a W-shaped recovery and then we start the expansion, just because of these structural elements now that we're putting in place, higher debt levels, higher sensitivity to higher interest rates. So long and short of it is, we're not going to have the same length of time to deal with the deficit. And as most of you know, governments don't do a great job at using time on their side to get balance or getting budgets back into balance. Case in point, the States has had 11 years, and what have we done? Canada's in the same boat. So I think it's almost inevitable that we'll see that. Capital gains tax changes has been speculated on in the market for a couple of years now. I think every year that we go through, people are surprised that we haven't seen it. People anticipated it was going to happen this year, and perhaps if we'd not had a virus, maybe it would have. I think at some point, it's the low-hanging fruit that governments go after first. So before we start raising income taxes on middle-class earners, we will look at things in the wealth sector, so things like capital gains tax. I've had a whole bunch of clients this week phoning me up and asking me, is there going to be a change to estate taxes? In other words, are we going to have an estate tax in Canada? Because a lot of accounts are talking about that. Are we going to see changes in taxation of primary dwellings? All of these now I think are possible, or maybe even more probable. But I would say the capital gains tax, just because it's been talked about for so long, is probably one of the first things that we'd be looking to, Matt, on that. In terms of the TSX, in terms of performance, the TSX right now is basically on par with the Dow Jones. We're down about 16.5%. Dow Jones down about 17.5%. Index ETFs have basically performed lockstep with the TSX, and that's what we would expect them to do. I know a lot of individuals have gotten away from passive investing. There has been, I think, a good argument made for active investing during this crisis. But again, ETFs right now have been tracking the TSX since March 23rd, and we've seen a similar rebound in the TSX. I mean, prior to April 14th, or as of April 14th, believe it or not, the TSX was up about 27% from the low. And I joked about this yesterday that, you know, we had the quickest bear market, or one of the quickest bear markets in history, and we also had one of the quickest bull markets in history, all within the confines of 4 weeks, which kind of gives you an idea of how fluid the situation has been.
That's great, thank you. Now, another follow-on question. Over the next few years, what impact do you think that this overall situation is going to have on the government's ability to support small businesses through funding and investment?
That's a really good question, Mike. I mean, I would say the default answer to that will be, it will be more limited than what it would have been prior to the pandemic for any government, right? So we kind of get away from what types of governments would support small business versus which wouldn't, but this pandemic has really, I think, put handcuffs on future administrations and future governments, federal and provincial. Handcuffs in terms of their wiggle room and maneuvering room in terms of addressing situations that need to be addressed. So supporting small business, which is the engine of employment growth in this country, is critical. Again, back to my earlier point, I think we probably could have done a lot more to backstop small businesses in this country and had those programs in place before we got into the pandemic. I joke with people, and not really joking, but had we had these programs in place so that we could have just turned them on, we could have literally sent everyone home for the month of March for a mandatory vacation, stop travel, block the borders, and we probably would have had better numbers coming out of it. And again, I know that's hindsight, but it's critical that we always have programs in place for small business. And again, I think beyond 2021, 2022, it's going to be extremely difficult for all governments to provide the same level of support that we'd be looking to them in normal times.
Oh, that's great, thank you. I think the next question's, I'm sure a lot of us are thinking this. So from your opinion, Andrew, what do you suggest businesses need to do over the next 5 years to prepare for other potential events like this, as far as financial preparedness?
Well, I think obviously you would start with balance sheet, looking at the balance sheet, making sure that your balance sheets are strong enough and adaptable enough to deal with this kind of situation if we went through it again. So making sure that you've got adequate credit lines, making sure that you've restructured your debt, taking advantage of low interest rates to maybe do some restructuring, free up cash flow. I think technology is key in this, Mike, as we've learned. I mean, some businesses can't remote, but I think it's imperative that businesses look to technology to find ways to insulate their business activity in times of stress. The next time we go through this, it may not be a pandemic, right? And I've said this before, that, the next time we go through this, it may just be a traditional type economic recession. We may see the same thing happen to corporations in terms of debt that we saw happen to the housing sector in the States back in 2007, 2008. So, how would I deal with that if I was a business? Because, I mean, that type of recession might not be as quick as what we're dealing with right now, but it could be longer lasting like it was in 08. I have to make sure that my business is there at the end of the day to survive. It's going to be scarred, but it comes out of it. So technology, I think, is going to play a greater and greater role in that. When we start scaling up from there, Mike, I think and I made this comment yesterday, that I think it's inevitable that we're going to see consolidation at all levels of business, right? Whether it's large cap businesses in the energy sector having to consolidate to survive, but we're going to see smaller businesses too, perhaps having to look at partnerships and forming, collectives to get through something like this in the future.
Now, kind of a follow-on piece to that as well is, so from your opinion, and this is a two-part question, so what business sectors do you feel will emerge stronger from this pandemic? And the second part is, what's your opinion on the retail sector? I mean, we know it was already at risk before the kind of pre-pandemic. Do you think it's going to recover, or do you think that large shopping centers and so forth are going to become obsolete?
I I think the way I would answer that, Mike, and it's kind of a similar answer on both fronts, and that is if we look at the two sectors that have been most impacted by this episode, positively and negative. Positive on the tech side. So sectors that support the ability to do business in a remote fashion, to do business where we don't have to have all of our employees in the same place, to conduct retail without too much disruption, i.e. Amazon. That trend was already in place before the pandemic. We've steepened that curve or that trajectory. Brick and mortar retail was already on a declining trend before the pandemic. We've steepened that. There's going to be less inducement for a consumer to go into a mall now or a crowded mall than there was back in January, February. So I think tech, those companies or those sectors that support a more remote economy are going to do best coming out of this. Retailers that are embracing that at a higher degree. I mean, we've seen Walmart become more online. I mean, a lot of companies now are going to play catch up with Amazon. Those companies, I think, are poised to do well in the subsequent quarters and years. Travel clearly is going to be negatively impacted, but I'll be careful on this point because I know what everyone's thinking is like, I'm never going to go on a cruise ship again. I'm never going to get on a plane again. And, I definitely think we're going to see a long-term recovery, or it's going to take a long time for things like cruises to recover. But people who have very short memories, and I remember back to 9/11, people said the same thing. I'm never going to get in the plane again because it's going to blow up. Or, after SARS in 2003, I'm never going to go to China. I remember going to China in 2005, and I don't remember being worried about walking around the streets of China. So I think people will travel again. They will go back on cruise ships. I think regulations are going to tighten up demonstrably. I think you're going to see cost structures for a lot of these companies, a lot of these industries elevate dramatically. So cruise lines are going to have to spend more money to meet tighter regulations. Airlines have already witnessed that after 9/11, and are going to have to do so again. And pretty much everyone is going to have to do it, from restaurants and everything else. There's going to be that extra layer now of government regulation that's going to have to be paid for. We've been doing it as a financial industry because of, cyber crimes and money laundering and terrorist financing. But I think those would be the two key industries, Mike. I think just traditional retail, I think will die at a quicker rate. And I think tech is just going to become that much more prominent and that much more important.
No, I think you're absolutely right. It doesn't look like we have any more questions. So Andrew, just want to thank you very much for taking the time to do the presentation today. It was excellent. I think you really answered a lot of our questions, and obviously we'll probably have you back in some format soon because we are definitely in times that are changing very, very quickly for sure. Thank you very much.
Thank you, Mike. Thank you to the cluster for the invitation, and all the best, and stay safe to everyone.
I'd also like to thank everyone else for joining today. There will be a survey that's being sent out, so please provide feedback. This was our first virtual Power Breakfast, and obviously we're hoping that we go back to traditional Power Breakfast soon, but should that not happen, we would love to get some feedback. And I'd also like to just say thank you to the Innovation Cluster staff. I mean, they've pulled together over the last month and a half. We basically do these meetings every day with Zoom. We now use Zoom to connect with all of our clients, and really as an organization, that is built in innovation and tech, we've been able to adapt pretty quickly to support our customers. So I just want to thank those that are on here because they've definitely worked lots and lots of hours, and I think we have early morning Zooms and late night Zooms sometimes. So just like to thank you very much. And last thing, don't forget to follow us on social for updates, new events, and everyone have a great day. Thank you. Bye.